Housing affordability in the US has never been worse on a dollar basis. The income to buy a house versus the median income, the gap between how much money you would need to buy a house versus what the median income earner actually makes in the US is bigger than it's ever been. So this means that homeownership has never been this far out of reach for this many people. I'm going to talk a little bit about why that is specifically and what happens afterwards, because we just saw the same thing take place in Canada in 2022, and the way that it corrected very naturally is really worth taking a look at for what could be probably the most likely outcome for the US. So if you look at the income needed to buy a house versus the median income, it obviously got pretty bad during the run up to the global financial crisis, where the gap was about $61,000 over about $45,000, with the understanding that a lot of money supply has entered the market between now and then through quantitative easing and other programs, meaning that inflation probably makes this gap relatively comparable, right? It's about $26,000 today, and it was about $10,000 at the 2006 housing bubble peak. So today it's about 2.6 times higher than it was then. If you look at this on a percentage basis, house payments as a percentage of median household income, which we see used in most OECD nations as a look at housing affordability, we're actually above the 2006 housing bubble peak in the US. Still not even close to the 1981 peak housing unaffordability when interest rates hit 18% during the Volcker era of central bank policy. If you look at housing affordability in Canada, it kind of went through similar cycles with housing. It went through the similar peaks in the 1980s. In Canada, we had one in the 1990s, and ours was less bad during the 2008 era. But after these big peaks, you almost always see a return to levels of normalcy, and that's accompanied by a recession, which is the gray bars here. And this is kind of what sets me up to take a look at buying conditions. So this is whether or not people want to buy homes, right? And this is from Bravos research, and it shows that people don't feel like buying homes. Buying conditions for housing, as surveyed by consumers, are the worst they've ever been. And usually when you see a collapse like this, it is again accompanied by a recession, and the buying conditions begin to improve as we get through this flat period or this trough period in these gray bars, the recessionary periods. At the same time, if you look at buying relative to renting, buying has never been a worse deal. And a lot of this is because prices haven't really come down a ton, but interest rates have gone up. And so the cost to buy right now on average is just shy of $2,700 a month, and the cost to rent is about $1,845 a month, meaning that the gap between buying and renting has never been larger than it is right now. And again, you can see some periods where it got quite big during the 2006 housing bubble, and it pretty quickly returned to that mean where it tends to follow the cost of rent a little bit more closely. Again, probably worth thinking about how much money has been injected into the economy to the cumulative inflation of this cost to buy versus cost to rent on a dollar basis maybe isn't necessarily the best. So when you really want to look at it, you want to look at it on a percentage basis, because that doesn't depend as much on the value of a dollar, right? You can't just throw currency debasement at it and say this isn't a fair comparison because dollars are worth a lot less than they were in 2008. If you look at it on a percentage basis, it's 42% more to buy a home than renting one, which is well above the historical average of 14% and kind of in line with those GFC figures between 06 and 07. And then finally, you can look at it on a city by city basis. Real estate is very much a geographical thing, right? A lot of these markets are far worse than they were during the GFC, and a lot of markets are doing better than the GFC. If you look at the US average, though, it does appear to be a little bit higher for real mortgage payment price index. And this is real, again, adjusted for inflation. The Case-Shiller home price index adjusted for inflation and mortgage rates would indicate that we are at a higher level of housing unaffordability than 08. Obviously, structurally completely different. There's no insinuating that the setup is comparable, but economically, this is taking a lot out of the consumer, and this will have a long-term drain on the economy because it's less and less money being pumped into residential investment. That's less money that people can use on spending on things, on investing in their businesses, et cetera. And this is a low and slow gradual drain on the economy. And I'll return to Canada as an example because Canada has already come past this peak. It's starting to see an improvement in housing affordability in Canada. But if you look at Canada versus the US on a GDP per capita basis, what's happening really in Canada is that Canada's GDP is suffering as a result of too much money, too much of the household consumption being pumped into the housing market. There's no economic diversification. There's no money being spent outside of residential investment because people are spending all of their money just servicing debt. The US is obviously structurally different because everyone got 30-year mortgages at record low rates, going to keep those payments affordable for the lifetime of the mortgage for all of those individuals. And so I think that's where there's a degree of protection on the resale housing market, but the long-term impact of people in the present market who didn't buy during that period not being able to buy houses is one of the big things to watch out for. And I think it's going to be a very, very big theme in the US in 2025.